Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are talking rates. 10-year note yields hit their highest since February as yields continue to climb. We saw this climb start about 2 weeks ago. Recall not too long ago we saw talking about yields getting close to 270, kind of forming that range we've seen over the last several months, 271 to 295. Well, now we're nearing the top end of that range on inflation concerns, and it's not so much coming from the producer level or the consumer levels as the producer level, as commodity prices have really held firm. Oil prices, gold prices, metals, you name it. A lot of it on the heels of the trade wars, tariffs, whatever you want to call it, and it's starting to bleed into interest rates as we are now seeing yields creep higher while stocks kind of trade back and forth after a pretty big rally. They've held steady here over the last day or so with earnings kind of, let's just say, aren't coming in as colorful as they'd like or as bright as they'd like. But the Treasury market now seeing yields rise is an inflation concern that I think is one that we're going to start to pay more attention to. And if you look at volatility, volatility is higher, but still not in any kind of red zone. We've seen vols come off month to date pretty significantly in the Treasury space, suggesting that while we have remained in that range, the market has not been fearful of any major breakouts. Well, we are now nearing one of those levels, the top end of the range in yield, 295. We're not quite there yet. We got as high as 292, but we could be nudging higher into the weekend. That would, of course, give volatility a bid, or should give volatility a bid. So we are seeing vols not go down anymore, which I guess is the point. Vols have sort of reversed modestly. We aren't seeing a spike in volatility likewise until we probably, if we ever get through that level 295 and touch that 3% yield that we've been talking about for so long as being the target. I think that would be something, and I think that the market right now is anticipating with these inflation concerns, with trade wars, and with a Fed that really has been talking the talk over the last week or so about continuing to do gradual rate hikes, that I think that we could easily get to 3% before too long. And if we look at the last component here, let's look at the curve. Treasury curve continues to flatten. We've talked about this. I think you got to go back. You can go back a year, really, but you go back as far as you want and you watch the trending of the Treasury curve. 2s10s, 2s30s, 5s30s, 7s, 10s, whatever it is you want to look at, it's been flattening. Now, today we saw a significant steepening, and I mentioned that we're up. I think it's the biggest one-day steepening we've seen in 2s10s since March, and really go back to early February, late January, since we've seen any consistency of this type of steepening. However, yes, the 2s10s is steeper. Yes, it does. It is something that's positive, I think, for this market, given the fact that interest rates in the short end are going to go up soon. We need to see those back-end rates go higher in order to keep the yield curve from inverting. However, yesterday, we made the lowest 2s10 mark since September of 2007. So to say that we're off the ground here doesn't really give you a clear picture of where we are. We are still near those drop dead lows in the curve, and I think that is something that the Fed hopes will correct itself. I think they've tried to correct it verbally. I think that when you look at what they've done with their balance sheet, they're trying to correct it that way as well. However, it isn't working, and the uncertainty that we're seeing moving forward can probably be best cleared up if inflation rises slowly, which we're seeing, and if the commodity prices stabilize. But likewise, we need that growth component that we've been anticipating. End of April, we get the advanced first quarter GDP. It's expected around 2.2. The last GDP now we got was 2%. So we're right in that 2% range, not 3% like I think the market had been anticipating. So if that growth number comes in a little weaker, it could be a problem. Likewise, if it comes in stronger, we should see a continued steepening of the curve. And obviously, the Fed would be all happy and start clapping about the growth numbers that they've been expecting all along. So right now, the Treasury market seeing a little bit of a shift lower in price, higher in yield on inflation concerns. But as we head into next week, things could change a lot as GDP will become the focus. This is Todd Colvin coming to you from the floor of the CME Group.